RBI நிதிக் கொள்கை குழு கூட்டத்தில் எடுக்கப்பட்ட முடிவுகள் அறிவிப்பு.
Shifts in the global economy in the wake of geopolitical realignments and technological innovations. A large economy marching ahead with vast domestic demand, untapped resources, and demographic advantages, India can become the new growth engine for the world. In this background, the Monetary Policy Committee met on 8th, 9th, and 10th of August. After detailed deliberation on all relevant aspects, the Monetary Policy Committee decided unanimously to keep the policy repo rate unchanged at 6%, 6.5%. It's 6.5%. Consequently, the standing deposit facility, that is SDF rate, remains at 6.25%, and the marginal standing facility, that is MSF rate, and the bank rate stand at 6.75%. The MPC also decided by a majority of 5 out of 6 members to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. Let me now explain the MPC's rationale for these decisions on the policy rate and the stance. Headline inflation, after reaching a low of 4.3% in May 2023, rose in June and is expected to surge during July-August, led by vegetable prices. While the vegetable price shock may reverse quickly, possible El Nino weather conditions along with global food prices need to be watched closely against the backdrop of a skewed southwest monsoon so far. These developments warrant a heightened vigil on the evolving inflation trajectory. The cumulative rate hike of 250 basis points undertaken by the MPC so far is working its way into the economy. Nevertheless, domestic economic activity is holding up well and is likely to retain its momentum despite weak external demand. Considering this confluence of factors, the MPC decided to remain watchful and evaluate the emerging situation. Consequently, the MPC decided to keep the policy repo rate unchanged at 6.5% with preparedness to act should the situation so warrant. The MPC remains resolute in its commitment to align inflation to the 4% target and anchoring of inflation expectations. Further, with monetary transmission still underway, and I have given some details in the footnote of my statement with regard to this, when I say monetary policy transmission is still underway, there are some additional information given in the footnote. Those of you who are interested may have a look at it. Further, with monetary transmission still underway and headline inflation remaining higher than the 4% target, the MPC decided to remain focused on withdrawal of accommodation to ensure that inflation progressively aligns with the target while supporting growth. I would now like to provide our assessment of the growth and inflation scenario. First, I would like to take up global growth. The global economy continues to face daunting challenges of elevated inflation, high levels of debt, tight and volatile financial conditions, continuing geopolitical tensions, fragmentations, and extreme weather conditions. Belying earlier apprehensions, a number of economies have demonstrated remarkable resilience, and the grim prospects of hard landing appear to have receded. Nevertheless, global growth is likely to remain low by historical standards in the current year and also in the next few years. Despite upward revision in the global growth forecast for 2023 by the International Monetary Fund. World merchandise trade volume growth is projected by the WTO to decelerate from 2.7% in 2022 to 1.7% in 2023. Headline inflation is easing unevenly across countries and remains above the target in major economies. While the pace of monetary tightening has been scaled down, policy rates could stay higher for longer. Financial markets, which had been buoyed by expectations of an early end to the cycle of monetary tightening, have turned volatile with sizable two-way movements in response to recent rating events and incoming data. Turning to global growth, these external factors are likely to impinge on the growth prospects of most advanced and emerging economies. India is, however, expected to withstand these external headwinds far better than many other countries. The momentum of overall economic activity in India continues to be positive. On the supply side, crop sowing has picked up with steady progress in the southwest monsoon. The temporal and spatial distribution of monsoon has, however, been uneven. Industrial activity is holding ground, as is evident from the latest data on Index of Industrial Production, that is IIP, Core Industries Output, and Purchasing Managers Index, that is PMI for manufacturing. Buoyant services activity is reflected in healthy expansion in e-way bills, toll collections, railway freight, and a sharp jump in services PMI. On the other hand, commercial vehicle sales and domestic air cargo traffic contracted during Q1 of the current financial year. Aggregate demand conditions continue to be buoyant. Among urban demand indicators, domestic air passenger traffic, passenger vehicle sales, and households credit are exhibiting sustained growth. In the case of rural demand, tractor and fertilizer sales improved in June, while two-wheeler sales moderated. High growth in agricultural credit and improving sales volume of major fast-moving consumer goods, that is FMCG companies, suggest incipient recovery in rural demand, which will be reinforced by improving Kharif prospects. So what I have done under growth is that first I highlighted about the supply conditions, the supply side factors. Then I have highlighted the aggregate demand conditions consisting of both rural and urban demand. And let me now turn to investment activity. Investment activity gained further steam on the back of government capital expenditure, rising business optimism, and revival in private capex in certain key sectors. Continued increase in import and production of capital goods further reaffirms this trend. Construction activity also remains strong in first quarter of this year, as indicated by healthy growth in cement production and steel consumption. Capacity utilization in the manufacturing sector at 76.3% remained above the long period average, remained above the long-term average of 73.7%. The total flow of resources to the commercial sector from banks and other sources taken together has increased by rupees 7.5 lakh crore during the financial year 23-24 so far, that is up to July 28th, as compared with 5.7 lakh crore a year ago.